and that stock is called preferred stock. It's handled a little bit differently, and if you look on the balance sheets, you would actually see where it is called preferred stock. And I showed you guys that before when we were looking at the financial statements. So preferred stock is listed, and the journal entries are done exactly the same as they are done for common stock. So that's the easy thing for us to look at. The difference between it is that with preferred stock, if you look at the top, there are different voting rights. Now, this has actually changed over the last couple years in the sense that preferred stock used to be listed as no voting rights, but that has changed, and some preferred stock actually has voting rights. They have what's called a fixed dividend rate. So, and I hope I haven't frozen. I look like I'm frozen. Can you guys hear me okay?
I can hear you.
Okay, good. All right, because it looks like on my screen like everything stopped. Okay, so but now they actually can have, like I said, they can vote. There's something that we have, it's called a fixed dividend rate. All right, a fixed dividend rate means that they get to have a set dividend amount always. Now, that's definitely something that's not with common stock. Common stock, you don't know what you're going to get for a dividend. Sometimes you get this amount, sometimes you get this amount. So it's definitely just a little bit different. And then this is the big reason, besides dividends, that people buy common preferred stock is because it is a priority over common stock. So as I mentioned, the journal entry is exactly the same. People buy preferred stock, company issues it for cash. So if you sell 400,000 shares at $1 par, the amount that's going into preferred stock is the 400,000 times $1. This big dollar amount that you see for cash is just the dollar amount that it's going at on the market. And they didn't give us that price, but if you take 19,704,000 divided by 400,000, that's the market value that it was going at. All right. So now we look at what's called redemption. So that's when you were to sell stock back. So preferred stock's a little bit different in that a company, when they buy back preferred stock, it does not turn into treasury stock. It is called redeemed, and it then doesn't get issued back out again. So on this one, preferred stock, they redeem it back. They redeem it back at $1 par. So that's the amount that it was originally issued at. So therefore, it comes out of preferred stock at the $1. And then if it's costing us money, we're taking it out of additional paid-in capital. Because if we're buying it back, we're technically losing money, just like we would have for treasury stock, and then we're paying cash. The difference between buying back treasury common stock and preferred stock is it's a redemption with preferred stock, and then it goes away. And with treasury stock, we can keep it and put it back out on the market, or we can return it to the shareholders. So far what you have with preferred stock is it's recorded exactly the same way when we do our journal entries. But when we buy it back, it does not turn into treasury stock. It just is bought back. It's redeemed. But the journal entries are exactly the same. Where you're going to find a difference is what we call the dividends. All right, there are two types of dividends that you can have with preferred stock. All right. The two types of dividends are current dividends. Turn off my pen. Current dividends and cumulative preferred dividends. All right. Current dividends means that they get a dividend that year before any common stockholder gets a dividend. That's all that means. They get that year's dividend only, and they always get it before the preferred stockholders get it, common stockholders get it. Cumulative dividend means they get a dividend for every year, no matter if it's paid or if it's not paid. And sometimes when you just think about that, it sounds a little confusing. Like, how do they get a dividend if they didn't make payment? That means they're owed a dividend. Being owed a dividend is this phrase right here. Dividends in arrears. Right? Sometimes you see that arrears in a problem, multiple choice, on an exam. You need to make sure you can remember that in arrears means from behind. So if you see the word arrears or cumulative, that means they are owed all dividends. They must be paid before any common stockholder will get a dividend. So if a dividend is cumulative, it's owed. If it's non-cumulative, all prior year's dividends are lost permanently. They are only paid for the year that they are given that dividend. It's not letting me move. There we go. Okay, so let's do a little example here. So we're using Flavoria, all right? They carry only current dividends, all right? And they declared a dividend totaling $8,000 for 2018 and $10,000 for 2019. How much are the common stockholders going to get, and how much are the preferred stockholders going to get? So the way that we want to look at this problem is, the first thing you got to do is figure out how much are the preferred stockholders supposed to get. Okay? So this is how you figure out the preferred stockholders' dividend. You take the number of shares, 2,000, times the dividend rate, which is the 6%, which is given right here, times par, which I think is 20. It's awfully small. All right? 6% times the number of shares times par. So when we do that, we got 2,000 times 6% times 20. That means the preferred stockholders are supposed to get $2,400. So 2018, they paid a $8,000 dividend. That says here that it is a current dividend. And we just said that a current dividend means that they are paid for only that year, okay, which actually is fine, because if it's a current dividend, preferred stockholders should get $2,400, which means common stock is going to get the rest, which means they're going to get $5,600. 2019, they paid $10,000. Preferred stock is still going to get $2,400, and common stock is going to get $7,600. Because the preferred stock is a set dividend rate. So they will get $2,400 every year. All right, is there any questions about that? So that is a current preferred dividend. All right, silence is golden. We're going to the next one. All right, so there's your solution. We already did. So now we're going to change it up a little bit. Now it says we are the same, but we have some stock outstanding, and we are going to assume that they have dividends in arrears for 2016 and 2017. So same calculation, so we know that preferred stock is $2,400. We know that in 2018, they gave an $8,000 dividend. That was from the other page. They did not give a dividend in 2016 or 17. So if dividends are in arrears, that means they have to pay that dividend before they can pay the common stock. So 2016 is going to get $2,400. 2017 is going to get $2,400. And 2018 preferred stock is going to get $2,400. This is all preferred stock. So in 2018, what is left for the common stock? Well, if you add all that up together, you get $7,200. So that means common stock gets a whopping $800. So I'm going to erase this real quick just to make it neater. And if I add all that up, I get $8,000.
By the way, we can't actually see you writing, I don't think.
You can't? All my writing,
No.
You haven't seen it?
No, we haven't.
Wonder why. All right.
Your mouse cursor's frozen in the same spot.
Okay, see, I told you, okay, I'm going to stop something. Let me go backwards. I think I know why. Hang on. Because I tried doing something different and it didn't work so I could see you guys. I could see you typing, I should say. All right. Now let me put... You can still see the slide, I assume, right?
Slide is visible.
Okay. Let's. Does it take up your whole screen?
It does.
Okay.
Well, not now.
Now it doesn't?
No, now we have the preview for the next slide.
Yeah, that's a pain in the butt. Okay, let's not do that. All right. Now?
Full screen.
Okay.
Full screen.
Let me show you what I just did then. So did you guys understand what I did on the one before, where basically the preferred stock people just got the $2,400 in 2018 and 19, and the common stock people got the rest? Did that make sense?
Yes,
Okay.
I thought so.
All right. So it is recorded. So now let me show you what happens this year, since that wasn't... I'm glad you said something, Neil, because the whole time I've been writing, so that didn't make sense. All right, so now we don't, we got dividends in arrears. All right, and we calculated, I'm going to go ahead and calculate it again because it doesn't sound like you saw what I showed before. You take the 2,000 shares times the 6% dividend rate times par, and that's where I got the 2,400 preferred stock dividend. So now that we have dividends in arrears, that means that has to be paid before anybody else can be paid. So we are going to 2016 is getting $2,400. 2017 is getting $2,400. 2018 is getting $2,400. And this is all preferred stock. If you add that all up, it's $7,600. All three of those years get paid. And basically then that means that's preferred stock. Common stock gets $400. Wait a minute, that's not, I added wrong. This would be $7,200. Common stock gets $800. So that gets us our $8,000 that we had on the prior screen, because it said that in 2018 they gave an $8,000 dividend, and in 2019 they gave a $10,000 dividend. So the dividends in arrears affects 2016, 17, and 18. So the 2018, the common stock people, whereas in without the dividends in arrears, they got $5,600 because preferred stock only gave $2,400. Now, because of the dividends in arrears, all the preferred stock got paid for 2 years they hadn't paid dividends. It does not affect 2010 because 2010 there are no dividends in arrears, so preferred stock would get 2,400 and common stock would get the same 7,600 that they got in the prior year because there were no dividends in arrears. Does that make some sense? All right, Neil, now you gotta tell me what it says because I can't see it anymore.
It says, yeah.
Good. I knew that other way was too good to be true. All right, and there's your answers, just like I had shown. All right. And then this is just showing you just kind of from a company standpoint, you can actually operate with a deficit in retained earnings. That means you actually spent more money than you, quote, made, because net income was, you lost money in net income. You just can't operate like that for long periods of time. The reason that they were able to do that was because they had enough money in stockholders' equity, possibly through additional paid-in capital by selling stock. You were losing money in net income, so you sold stock to save yourself because you were still able to keep stockholders' equity afloat. Okay, a company can't do that for a long period of time, but you can do that if you have enough in your stockholders' equity. All right. And then this you've seen, this is our statement of stockholders' equity, that obviously the statement changed. When we were doing our trial balance, we looked at, oh, that was a bad draw. Let's try that again. When we were doing our trial balance, we had to come to the statement of stockholders' equity and look for this because we were trying to back into it. But now that we've moved on, we can now talk about these other columns. So treasury stock, first part of this chapter, notice it's a negative because the company has to buy it. So it reduces stockholders' equity. We have to spend our money to go get that. So treasury stock is a contra account and it's right there. Here's our common stock and our preferred stock. All right, so here, common stock, we started with $504 million and then we issued more stock. So stock went up by $2 million. Here under preferred stock, we started with 270, but if you look, we redeemed it. So it only reduces preferred stock. It does not create its own column like common stock does. And then the last column, this other accumulated comprehensive losses, that is other ways that a company will either make or lose money that does not fit into any of these other categories. So that's our statement of stockholders' equity. But you will be able to tell if a company has preferred stock, it specifically says that. And I haven't graded your annual reports, but if a company has dividends, this right here, notice it says preferred dividends and it reduces retained earnings. If it doesn't say preferred dividends, then it is not preferred dividends. So somebody might be able to speak up or type, did Lowe's have preferred dividends or did Lowe's just have dividends? And if they just had dividends, they're referred to as common stock dividends. So does anybody know if Lowe's had preferred dividends that should have been included when you were doing your ratios?
Lowe's did not have preferred dividends.
That is correct. And I can't see, well, actually I can, because now.
And that is 3 people agreed with me.
Awesome. Well, that means everybody there is right. If you didn't know that or you got it wrong, don't worry. It's not you won't. First of all, when I grade the annual report, just so you know, if you miss something, you miss it once. So for example, preferred dividends, I think was on there 2 times. So if you put preferred dividends, you will miss a 0.5 point and you only miss the 0.5 point 1 time. Also, if you get something like net income wrong, you put the net income wrong once, you only miss a half a point one time. You don't miss it every time you put the wrong net income, because obviously if you put the wrong net income once, you're going to keep putting it. So that's why it makes it hard to grade, is because I have to go in and look at every ratio individually by itself. And no, I haven't started. I was writing your test. So let's take a look at a problem. We are going to, if you want to pull up your working papers, we are going to look at, next page. I believe it is, I'm pulling up your working papers right now. We're going to look at preferred stock, I believe. E11. Yeah, okay, so the first one is E11.6. It is on page 13. And I'm trying to get my Word out of the showing 2 pages at once. I only want 1 page. View. Read mode. That's not the mode I want. View.